I'm going to talk about some savvy investors, people that have now moved away from buying properties in their names and they are now buying these properties in their company. And because they understand that the risk is limited to them if they're buying it in a company, and they are separating themselves from the company to from themselves to the company. So it's two different entities, right? Now, let's assume that the same thing has happened. R1 million property, and now you've got this 200,000. What else can you do? Well, the same scenario that we spoke about, where you can call the bank, you can do that, right? So I won't talk about that because you can do that, owning it in a company. But the second scenario that I want us to talk about now you have in a company, is that now your company's value has changed, right? I know I'm introducing something new here. So remember, you have a property, the property has its own value, but the company also has its own value. So the company itself, because now it's got its own value, you can also go to the bank, and then the bank will evaluate either the property itself or the company itself. And then they can say to you, oh, well, we can give you 200 more. We can give you 400,000 more. Why? Because the value of the company is X. And for that reason, you would have just released that equity. That money does not get paid to you directly. So for in some banks, what normally happens is that there's actually an account, it might be a flexi account or things like that. They will release that money in the current bond that you have. Or in some cases, what they will do is they will pay you out, yes, in a designated account that you choose. Obviously, you just need to follow that paperwork, and there you are. So two ways in which you can then be able to release that money. But I want to throw in another caveat to you guys, for guys that are like super savvy, like they understand, sophisticated investors.